So guys, July was an extremely hot month for dividend stocks. If we use SCHD as a benchmark for the broader dividend market, we'll see returns for the month that surpass both the S&P and the NASDAQ. And outside of the fund, there were many dividend-paying stocks that also delivered even stronger double-digit returns. As a result, when dividend stocks en masse are moving up, that does mean less deep discounts for us to take advantage of, but there are still always good buying opportunities to be found. And in this video, we'll be talking about 3 of them, all of which still look like great buys as we head into August. But real quick, before we get to those, I want to hear from you. Leave me a comment below and let me know which stocks you currently have your eye on. I'd be curious to hear what you think is looking good. So guys, it's no secret that the restaurant industry has been going through a tough time lately. Many of the dividend-paying companies in this space have seen their share prices take a big hit, largely due to a mix of inflation and changes in consumer spending habits. Long story short, with everything getting more expensive, people have become less willing to spend money on eating out, even at places that typically are known for having cheap food, because they're not really offering that as much as they used to, and that's what we're seeing play out with McDonald's. Instead of raising prices in line with inflation, as we can see, some restaurants have raised them above that by quite a bit. And in the case of McDonald's, while general inflation over the past decade was around 31%, McDonald's raised their menu prices by a whopping 100%, with most of this happening just in the last few years, which definitely has raised some eyebrows with their customers, and rightfully so. Throughout its existence, McDonald's has been the go-to place for affordable fast food. You know, you can think back to the dollar menu, which it doesn't get any cheaper than that. And in an attempt to restore that image and win back the budget-conscious customer, McDonald's did recently introduce a $5 meal deal, which they've decided to extend to hopefully attract more customers. Now, as McDonald's prepares to release its next quarterly earnings, which will be coming out on July 29th, so the day after I'm posting this video, so by the time you're watching this, there is a chance that those numbers could already be out. But anyway, it'll be interesting to see what those numbers look like and how the share price responds to that. In the meantime, though, taking a look at McDonald's share price performance over here on Seeking Alpha, we can see that in the last 30 days, it's down 1.5%, which is not a super crazy drop, but if we zoom out to the year-to-date performance, so far in 2024, McDonald's is down 15%, so that's a much more substantial drop in that time period. And if we zoom out once more, looking at the last 365 days, this is going to leave McDonald's with a 13.6% share price decline, and it's also going to leave them not too far off there from their 52-week low. Now, jumping over to the dividend stats, this drop in share price is going to leave the forward dividend yield just a bit above the 5-year average. We can see right now it's sitting at 2.65%, so a pretty respectable yield, but this is also 14% above the company's 5-year average yield. And then if we look at the rest of the dividend stats, everything else here is looking pretty good. The payout ratio is pretty moderate, you know, about 50%. No cause for concern there, in my opinion. The 5-year growth rate's looking pretty good as well, also decently moderate, coming in just under 8%. I'll take that. And they have a pretty extensive dividend growth history too, 22 years of growth, which almost makes McDonald's a dividend aristocrat. A few more years for these guys and they'll be there. Now, as we already talked about, as a consumer discretionary company, McDonald's is naturally affected by the sentiments and the spending habits of the consumer. You know, when people tighten their budgets, eating out is often one of the first things that they cut back on. However, McDonald's has a unique competitive advantage that can provide some resilience during tougher economic times when people aren't as willing to spend, and that's its franchise business model. As we can see here, a whopping 95% of McDonald's restaurants operate under this model, which reduces some of the financial risks that typically come with running a restaurant chain. In about 40% of these franchise locations, McDonald's actually doesn't invest any of the capital to open up the location. Instead, franchisees provide the funds to do so, and McDonald's just collects royalties from them. For the other 55% of franchise restaurants, McDonald's invests in the real estate and the building of the location. In these cases, McDonald's acts as the landlord, collecting rent along with a percentage of sales as royalties from the franchisees who operate the restaurants. Overall, this setup results in a more predictable and consistent revenue stream, which definitely comes in handy when consumer spending isn't as strong. And this also helps McDonald's maintain higher profit margins compared to a lot of their competitors in the quick service restaurant industry. At any rate, all of this is to say that if things do continue to head south, I'd still feel pretty comfortable owning McDonald's. I think it's a great and iconic business, and I think right now is a pretty good time to consider starting a position or adding some more shares if you've ever been interested in this company. Now, Now, I'm sure you've heard of L'Oreal before. It's a very popular brand, but you might be surprised to learn just how diversified this company actually is and how financially strong they are too. They operate in a few different categories, from skincare to makeup, hair, and fragrances, all of which saw really nice year-over-year gains in their first quarter earnings, and some of the brands they own and make products for in these various categories would be all of these here. I'm sure you'll recognize a lot of these names, along with some of these in the realm of consumer products. You'll likely have heard of Garnier and Maybelline. In dermatological beauty, they have La Roche-Posay and CeraVe, which are very popular. And then in their line of professional products, which would be like hair care products used in salons, they own Redken, Matrix, and Pureology. And in fact, if you go to cosmetology school, like if you're going to become a hairdresser or something like that, there are full-on Redken schools, and there are other schools that will only use Redken products. So you're actually learning the craft using their products. And then when you come out of school and actually start working in the industry, you're likely to continue using those products just because that's what you know. Now, in all of these different divisions, L'Oreal has managed to pull off strong growth across the board with double-digit year-over-year gains in almost all of their different divisions. And since 2019, the company has seen their revenue grow by a compound annual growth rate of more than 8%. And they're extremely profitable with a 74% gross profit margin and a near 20% operating margin, both of which have expanded over the years as well. But still, despite the strong fundamental performance, L'Oreal's share price just can't catch a break. I mean, in the last month, we can see it's down about 6.8%, and we can see that the drop really kicked off here on June 27th and came as a result of the company's CEO announcing lower growth expectations ahead in the beauty market, which had a subsequent impact on other companies in the industry as well. But anyway, with that drop for the month, that's going to leave L'Oreal with a negative 12.75% return so far in 2024, so quite a big drop there. And if we zoom out once more over the last year, this is going to leave them down 4.25%. Now, having said all of that, even though the CEO is expecting lower growth ahead, which maybe doesn't come as much of a surprise considering what we were talking about earlier with consumer spending habits, at the same time, once again, this company is still extremely profitable, and this is a consumer staples company, so I do think all of the different product categories listed here would still be heavily sought after by the consumers who regularly use these products. Anyway, as far as the dividend stats go, the forward yield for L'Oreal is coming in at 1.6%, so the yield is a bit on the lower end, but it is still higher than the company's 5-year average yield to the tune of about 18%, so there is that. And the rest of these stats are looking pretty decent as well. I mean, the 5-year growth rate's coming in nice and high at about 10.5%, and they have a 7-year dividend growth streak. Now, I actually have L'Oreal on one of my watch lists. This is my list of companies that I might want to buy, so basically these are companies I just want to keep a closer eye on. They're ones that I'm kind of chewing on and doing some more research into to decide if, they might be a good fit for my portfolio. But L'Oreal's here on this list. Actually, McDonald's is on this list as well. But regarding L'Oreal, I think this company checks a lot of boxes, and I really like the direction the share price is headed. I'd love to see it continue to get cheaper, and overall, I definitely think this is a great company to consider. Anyway, guys, this third stock that we're talking about today is Kenva, which is a company that I've actually never talked about before here on the channel, but it's another really solid consumer staples company, and it's just looking like an increasingly good buying opportunity. Now, a little background on this company. Kenva was spun off from Johnson & Johnson back in August of last year, so a relatively recent spin-off, and it contains all of the consumer products that used to be under the J&J umbrella, like all of these ones here, most of which, or probably all of which you recognize. Now, as opposed to the last two stocks that we looked at, Kenva's actually seen a slight gain in the last month where they're up almost 1.25%. But if we zoom out looking at the year-to-date performance, there's still been a pretty big drop-off in the share price so far in 2024. It's down 13.2%. And then zooming out once more, looking at the performance in the last 365 days, which goes back to pretty much when Kenva was spun off from J&J. In this time period since its inception or since the spin-off, it's down 24.3%. So in its relatively short lifespan so far, Kenva's share price has done nothing but go down. With that though, I think that only stands to benefit investors because in the meantime, as that share price is going down, that dividend yield just keeps getting pushed up higher and higher. And right now, the yield is pretty dang high, especially for a consumer staples company. I mean, it's sitting at 4.3%, which is a bit higher than what you'd even get from investing in Johnson & Johnson. But with that, because Kenva is still so new, the company has yet to really establish a dividend growth history, which is why we're not seeing anything else here on the chart. But earlier this week, they did actually announce their first ever dividend raise for 2.5%. So At least there's something. Overall, I think if you're looking for a stock that offers those sleep well at night qualities, Kenvue is a really solid one to consider. It's at a great price, and I actually think the same is true for all three of these companies that we've looked at today. With that though, these aren't the only ones. There are still quite a handful of other honorable mentions out there that I think you need to keep your eye on. The first of which is going to be AGCO, who has actually seen a really solid gain in the last month. They're up 6% just in the last 30 days, but year to date, they're still down quite a bit, down 12.8%, and over the last year, AGCO is still down 22.6%. Moving on, I also think Comcast could be another one to watch. They're also up in the last month by almost 4%, but year to date, they're still down 9.5%, and over the last year, Comcast is still down 7.5%. And then next up, Dollar General is another one to watch. They've seen a big drop in the last month. They're down 8.66%, and year to date, this is going to leave them with a 13.14% drop, and in the last year, this is going to leave them down almost 30%. But anyway, moving on, also keep your eye on Dolby Laboratories, DLB. I really like this company. In the last month, they're pretty flat, up 0.1%, but year to date, Dolby is still down 9%, and if we zoom out once more over the last year, they're down 12%. But overall, this is a really solid company. You guys should look into it if you've never done so. But anyway, the next stock to keep your eye on is FactSet Research Systems, FDS, and they're up just a little bit in the last month by 0.7%, but year to date, FactSet is still down about 13%, and in the last year, they're down 5.7%. Anyway, moving on, this next one is LVMH, and we actually talked about this company in last month's video, and since then, it's down even more. For the month, LVMH is down 6.7%, which is going to leave them with a year-to-date loss of 11.2% and a decline in the last year of about 20%, and they're really not too far off there from their 52-week low. And with that, moving on to the next stock, this one is Lamb Weston, who's, I think, seen the biggest drop out of all of these companies in the last month. Lamb Weston is down about 33%. We can see that they really jumped off a cliff right here after reporting some pretty poor quarterly earnings, but anyway, this drop in the last month is going to leave them down about 47.5% so far for the year, and in the last 365 days, it's pretty similar. They're down 44.3%. But anyway, here's another company that's just been getting wrecked lately, Nike, guys. They are down 22.3% in the last month, and we can see right here, pretty poor earnings for Nike. That's what caused this big drop there, but then year to date, this is going to leave Nike with a decline of about 33.2%, and in the last year, they are down 33.6%, and they're right there at their 52-week low. But anyway, guys, next up is another stock that just can't catch a break. We're talking about Starbucks, who's down another 5.6% in the last month. Year to date, Starbucks is down about 23%, very big drop there. And then in the last year, Starbucks is down 27.2%, and they are right there at their 52-week low. And then, guys, this next one is one of my favorite stocks of all time. We're talking about Visa, who's seen a bit of a pullback in the last month. They're down just over 5%, and this is going to leave them about flat for the year. So far in 2024, they're down 1/3%, but if we zoom out looking at the last year, Visa is still, they're up about 9.4%. So I would love just another month that looks just like this. I'd love to see an even bigger decline, but we'll see what happens. Now, those are all of the stocks that I think are good ones to watch right now. And in this next video right over here, I'm telling you about 3 more that are the exact opposite. These stocks are trouble, and you would definitely regret buying them. So click right over here to find out which ones they are, and I'll see you in the next one.